Hey everyone, thanks for joining us today. Just got a message here that we forgot to turn the sound on, so chalk that up to the first mistake of the day.
My name and only.
Yes, my name is Mike Marshall. I am on the product and sales team over here at Benzinga. What we're going to be doing is showing you guys a little bit about the Benzinga Pro platform, but mainly trying to gear it towards the educational piece.
Yep.
So we would love to hear some feedback or even some questions as we go through this webinar. So feel free to drop them into the chat and we will get right to them. Brent, if you wouldn't mind introducing yourself and telling the people out there what you do here.
Yeah, thanks, buddy. I'm Brent Slava. I'm one of the Benzinga news desk reporters. I am tracking a ton of news feeds. I'm tracking a ton of sources out there, a ton of people on social, etc. I only want to get everyone out there, our users, our readers, the most important headlines, information that's going to move a stock. If there is a piece of news that I read, I don't think it's material to a company or to a sector, I don't think it's necessarily going to move a market, I'm probably not going to post it. So again, we're kind of, weeding stuff out, we're curating, we're aggregating, we're also breaking news. We do have a reporter team who is going out there trying to find unique, exclusive information that isn't out there. Mike's pointing to the team, some of the team right there. You can maybe kind of see it back there. And I've been doing this thing for about 10 years or so now. I got a couple notches under my belt. Suddenly, 10 or 11 years later that I've been doing this stuff, I started my career in the stock market by pretty much just trying to understand why stocks move. My buddy and I, we would skip our econ classes in college and we would sit on our computer at home and we would look at charts and try to describe and go find out why that stock was moving at a given minute. And hey, what do you know? That's pretty much what I do for my job now. So it worked out well, definitely.
Excellent. And, just to remind all of you guys out there, this is just information. This is not for you to take it and go make investment decisions on it. Just strictly educational,
Yep.
Our thoughts and kind of a lot of the feedback that we hear from the users. And we're just trying to make sure we're passing that information along to you guys.
Great. Everything we want to do at Benzinga, a lot of what we want to do here is around getting you users, readers, investors, traders, the most information so that you can make your own decisions. We don't want to tell you to buy or sell a stock. We're not going to do that, but we're going to give you as much information, as much perspective as we can so that you can go make a very informed decision and feel confident about a buy or sell that you're doing.
Excellent. Is there any intro that you'd like to start off with on the topic today? So three stock topics that you should know.
Yeah, so this is kind of cool one. A lot of times Mike and I and the rest of the webinar team will kind of pick out the ideas, what we think is providing cool education, useful information. What we want to hit you with today is kind of like a users select what we're talking about. So these are three things that we get asked questions a ton about. I'm talking to traders and investors who are needing information. Mike, you're talking to our Benzinga and Benzinga Pro users, and we hear this stuff all the time. We hear, hey, I'd love it if you could tell us a little bit about dividends, or I'd love it if you could give us some basic education on options. And so we kind of said, we have been getting a lot of good requests. Let's do it. So three things we're going to talk about today. We're going to talk about some basic stuff. We're not going to get advanced. We're going to talk about dividends. We're going to talk about options, and then another one, which is what we're calling trade ideas. It's basically how do you find new ideas on what you want to invest in or trade.
Excellent. Perfect. So Brent, let's just go ahead and dive right into it here. I'll give you a little scroll. Looks like first topic we're going to start with is dividends. And what we're going to try and do on this webinar is while Brent is kind of giving us the nice educational piece, I'm going to be kind of playing around over here on the Benzinga Pro platform to show you guys how you can apply some of these things in the real world. So knowing that Brent's going to dive into dividends, I'm just going to pull up this little calendar here.
Yeah, what'd you do right there? You clicked, do that again. I missed that. I'm sorry.
Yep. So a couple new features, you can hide the sidebar, and then you can also just select the calendar icon.
Okay.
So that brings you up to all of our calendars that we have. You see all of the different calendars. So if you want to see analyst ratings or sun.
Et cetera.
Yep.
There's the one we need,
Yep.
dividends. Okay, so some important dates that you need to know about when you're considering a dividend. If you are looking at a stock that has a dividend and you're really new to dividends, you don't know what to do with it, what the important stuff is, I'm going to give you some important dates. I'm going to walk you through how important the yield is and what that means, and why dividends in general are important, what they mean for an investor, what they mean for a trader. So some important dates that you need to know about. Let's see. So when a dividend is announced, when the company issues a press release that says, hey, we're GE, we're going to issue a 20-cent dividend, quarterly dividend, that's up from 18 cents. They're raising their dividend. On that day, the day that the company announces a change in their dividend, the stock is going to react to that. Meaning, like, if they raise the dividend, investors are happy, they're going to bid the stock higher. If they cut their dividend, investors aren't happy that they're going to be getting less of a consistent payout, and the stock could fall. So it is important to know the date that that news was announced. You, again, are going to see that reflected in the chart. What's also another important date is called the declared date. And this is the date that a company will actually put some defined terms to a couple other dates we're going to talk about here in just a second. That is the record date and the payable date. So the declared, and Mike's pulling up some stuff here, and you're going to see a lot of these phrases that I'm talking about as column headings here on our dividend calendar. And what this dividend calendar is showing us right now is all of the dividends that are going to be paid today. Or excuse me, actually we're looking at, we're sorting by X dividend date. So we're looking at all the companies that are going to have X dividend date as of today. And I'll explain what an X dividend date is in just 1 second. Record date, what is the record date? So that is the date that a shareholder of a stock will recognize as eligible for that dividend payment. So record date is the date that the company will go through its books, see all of its investors, and if the date, like for example, if the record date is August 2nd, you have to be a holder of that stock on August 2nd in order to be eligible to get paid whatever that dividend is at a later time.
So quickly, just to interrupt, what would be the difference between the payable and the
record date?
Yes.
Okay, so that the next one is the payable date. That's the date that if you're an investor in GE and they pay you a dividend, the payable date is the date that you're going to see that cash in your brokerage account. So that's actually the date that they're going to pay it to you. The difference between the record date is basically the date that you get flagged as being eligible to be paid a dividend. The payable date is when you're actually paid that dividend.
Okay, so if I wanted to get paid any of these dividends right here, I have until the close today pretty much to buy this stock.
Let's see. So we need to, if you're sorted, I was going to say, if you sort the calendar by record date, if you are a shareholder of, let's say, TD, Toronto Dominion, by tomorrow's close, then whatever the payable date is, you're going to get paid on that date, whatever the dividend is on that date. And
Perfect.
The payable date is actually
Halloween.
Halloween. Cool. Okay, there we go. Awesome. All right. So the only other one that I didn't touch on, and this is probably the most important one for a lot of dividend traders, dividend investors, is the one that's first on our calendar here over on the left side, and that is the ex-dividend date. And what the ex-dividend date is, the date that a company's stock price will reflect the value of a dividend being paid out away from the value of their stock. This is kind of hard to understand, but let's use an example to demonstrate that. So let's say that TD is going to be paying almost a 50-cent dividend. On the 5th, that's today, what technically should happen is, because the company is losing 50 cents, about 50 cents for each shareholder that has a share, that value, 50 cents, should come out of the stock price, right? They don't have the cash anymore. They're paying their shareholders back in cash. They are actually, removing that 50 cents per share from their balance sheet. They don't have it anymore. So it should not be reflected in the price of the stock. And on the ex-dividend date is when you see that happen.
Okay, so.
Yeah, bounce some questions back in.
So, and maybe I heard that wrong. I think I was thinking of it a different way, but let me know if this is,
Okay.
this is what it is. So on the ex-dividend date right here.
Yep.
At the close, would it be the stock price of the close, is what we would be making that 3.4% and not the stock price on the 31st?
So the payable date, that's a really good question. So, we're talking about like basically logistics of the dividend being paid, meaning like moving money around.
Yep.
And value coming out of the stock on the ex-dividend date.
Okay.
So like, let me try to think of it another way. Maybe I can do.
Well, I think we can look at it kind of right down here with some of these data points on, would that make sense or no?
Let's see. So this, you did say something that I think was inaccurate in there, Mike. At the this price action on the ex-dividend date is going to be happening right at the open. So right when the stock opens that day, if it's 9:30 a.m. in the morning, if they're paying out a 47.93 cent per share dividend, right at the open, TD shares should have been down 47.93 cents.
Okay.
To show the value of that dividend being removed from the company. So I said very deliberately, very specifically, technically, this is technically supposed to happen because it doesn't always work that way. There could be other news happening, there could be something else going on, etc. But technically, the value of the dividend should be removed right at the open of trading. So why this is really important for, maybe like a newer trader, a newer investor, is sometimes I get people reaching out to me and saying, oh my gosh, Apple shares are down $1.50 today. I don't know why. I'm looking everywhere. I can't find out why. We look on the dividend calendar and, hey, what do you know? In Apple, today's an ex-dividend date. So again, at the open, right away, I was totally guessing when I said $1.50. So it looks like Apple's last dividend was 63 cents. So on the 10th of August, when Apple paid out its 63-cent dividend, technically, at the very beginning of open, that price should have already been down 63 cents. So why this is important for a trader, why I can reassure people when they ask me this question, is they know what the news item is. They know that, okay, it's pretty definitively the fact that there's a dividend being paid out today. Don't freak out. There's not, some bad news about iPhones or anything like that. This is pretty much in the normal course of trading and getting paid out through a dividend.
Excellent. And what is interesting is I pull up the chart here, August 10th, it looks like the movement for the day was negative. That's a lot of shares being paid out and a lot of money being paid out. As a day trader, you would see the reaction and you'd probably, try and make sure to capitalize in that.
Absolutely. And so we're staying basic here. There is a rather advanced strategy that I think a lot of you would like, but we don't want to go into it here today because it is pretty advanced, and it's something called dividend capture strategy. And it's basically taking advantage of the ex-dividend date, the value that comes out of the stock on the ex-dividend date, and combining, the understanding that a stock is going to react when the ex-dividend date happens, and combining that with actually getting paid a dividend. So what I want to do here is, if anybody is interested in what I just said, dividend capture strategy, if you're interested in hearing what this is about, give me a message and I'll put in, Mike's typing in something here. I'll see what he's typing in. VIP.
I was just going to have him drop it into the alias that a few of us are on.
Okay, sweet. Yeah, let's see what you got. So VIP accounts at benzinga.com. So this is, like Mike said, this is the alias that a few of us are on. If you're interested in hearing more about dividend capture strategy, send a message, and it's some good feedback. Maybe we do another webinar on it. Maybe I can just chat with a couple people personally. So let us know.
Excellent.
All right, so Mike, grab your left side of your Benzinga Pro window there and pull it over, and let's see what else we got here in dividends. Okay, so dividend yield. Why dividend yield is important and what it should mean for investors out there. So dividend yield is basically the proportion of the dividend that the company will be paying out over its stock price. It shows you sort of the factor, sort of the magnitude, a scale of how beefy or slim a company's dividend payment is. So let's see, we have yield right here, Mike. Look at this one, Mike. So Mike highlighted Kayne Anderson. The ticker is KED, and he clicked it, and you can see it's kind of highlighted right there. Actually, close that thing real quick, Mike.
Yep.
So this company is paying out a 40-cent dividend, and that makes up almost 10% of the company's stock price. So it looks like the company. We click again, Mike, and open up a widget, details widget here. So stock's about $17 stock or so. They're paying out $1.60 annually. They're paying 40 cents per quarter or $1.60 annually, which gets us to about 10%. That's a very fat dividend payment. This company is really paying investors to buy shares, sit tight, believe in them for long term, and get paid while they're waiting a nice 9%. 9% that's a huge yield. If you think about how much the S&P moves in a year, you might get outperformance by just capturing this company's dividend. Think about that, Mike.
That's great. Absolutely. That's
right.
why that's what stuck out to me right there.
So just to give you, a couple little factors, what you should be looking for in a dividend yield. There's nothing wrong with a lower dividend yield. If you see a dividend yield that's 0 to 1%, that's a rather sort of low dividend. But there's probably good reasons why it's low. Meaning maybe it's a growth company and they're not into their value stage yet. They don't have a ton of cash. They're not comfortable paying their shareholders out in a dividend yet. Maybe they're using it for R&D. Maybe they're using it for acquisition. The management team is using it for reasons that they feel is going to be more impactful than a dividend. So just because you see a low dividend yield, don't dismiss that company. A dividend yield that's in the range of 1 to 2% is like rather normal. A dividend yield that's over 3% is where you're starting to get to be like a pretty high dividend yield. And you picked out KD there, Kayne Anderson. You picked out one that happens to have a really strong dividend yield. If you're looking for another couple opportunities for fat dividend payments, look at some REIT stocks. So just type in, let's do ticker ARR, Mike. ARR, this is Armour Residential REIT. And REITs traditionally have really strong dividend yields.
And whoa, once a month? Is that what that?
That's what that means, yep, frequency, once a month. And look at where, the yield was at, in 2016, this was like a 20% yielder. So I will warn you on one thing for dividend yield.
Fred C. wants to know, how safe is it?
Hey, there it is, Fred. Thank you very much, Fred. Really good point. So,
it sounds too easy to me.
Too good to be true. So that is definitely the thing I was going to warn you about. Really good point, Fred. When you do see a higher dividend yield, what you should be thinking about is the company is putting more of their cash out there to pay back their shareholders. They're very thankful for their shareholders. They want to give them a ton of money. However, when you see a dividend yield like 20%, it could mean that, for the management team, maybe their dividend payment is like a low-hanging fruit. Meaning if they're looking for, maybe one quarter they're a little strapped for cash and they're saying, hey, we just need to save, like $100 million. If we could just save $100 million, we could fund this project to go forward. Maybe we should cut our dividend yield. Maybe we should cut our dividend. So again, super good point, Fred. I really appreciate that little point.
Anything that you want to wrap up with here on dividends so we can keep it moving? And if there's anything else you guys want to know about dividends, drop them in. We will let Brent wrap up on dividends, and then we're going to move on.
Cool. So I think I touched on, the last bullet that we have here, which is why are dividends important, which is the companies are paying you to basically sit and wait. The companies are showing you how much they appreciate you being a shareholder, and in addition to the earnings that company is going to be making and you're going to be getting as the stock price goes up in value, they also want to pay you just for being a shareholder. So it's totally another revenue stream. in addition to price appreciation or accumulation, that kind of stuff. We can get into some more advanced stuff on dividends, but we might have to save that. We will have to save that for another webinar, Mike.
All right, doesn't look like anyone else has some questions.
That's good. Let's keep it rolling.
All right, a lot of you option traders tend to enjoy our product, so this is for you.
Cool, and we're gonna start basic. You can get so crazy advanced with options, but we're gonna start very basic, and we're gonna kind of work our way up from there. We'll probably do a ton of other webinars about options. Let's start with the basics. So important parts of a dividend, or excuse me, of an option contract that you need to know about. Basic stuff. Is the contract a call or a put? A call, if you are the seller, if you're the writer of a call, it means that you are looking to capture some downside in the stock. If you're a buyer of a call contract, you want the stock generally to go higher. You're looking for price appreciation of the underlying security. If you are, let's switch that around now. If you are, let's talk about puts. If you are a writer of a put, if you are selling puts, you are looking for upside. If you are buying a put contract, you are looking for downside. So, you know, we can get super technical about describing a call or a put. Let's just say, to make it easy for your understanding, for my explaining, call is upside bullish, bear is a put downside.
Great.
Cool? Okay, cool.
You want to buy the calls, sell the puts.
Okay, there you go. So another important point, the expiry. And so Mike was kind of highlighting in our Benzinga Pro option alerts here, as I was talking through call and put, he was highlighting the call, he was highlighting the put. Can you highlight the expiry for us, Mike? This is a little test for you. Expiry, there it is. Okay, so what the expiration is when an option contract happens, there is an agreement. The agreement is that by the date, by the expiration, if a stock is at the next thing that we're going to talk about, the exercise or strike price, then there is a option to exercise that contract. And what happens is one contract equates to 100 shares of an underlying stock. If a trader chooses to exercise that contract at the expiration, what will happen is they will get in turn for that one contract 100 shares. So this is how options basically started. But nowadays, most traders don't do that exercising that I just described. What they just do is they just trade the contracts themselves. So the kind of last important thing is the contract price itself. And that is this number over here with the dollar sign. Nope. Yep, that one right there. Highlight that one. So what's happening here in SGMS? Let's go through like specifically this contract in depth here. So there's a trader out there who says by November, if shares of SGMS Scientific Games are at $50, the street right now, the market right now is valuing that option to buy shares at $3.76. So kind of like, you know, an immediate, what's the word I want to use? Something that jumps out to me right away is the difference in value. So right now you can go out in the market and you can buy shares of SGMS for about $50 a share if you want. You can get one share for $47, excuse me, thanks Mike, $47.65. Or if you want to get a little riskier, if you want to, you know, use a derivative like an option contract, you can gain exposure to Scientific Games, ticker SGMS, by going out there and buying some of the calls for only $3.
Yep.
And so when you're working with lower price securities, when you're working with lower price instruments, the gain that you can get is more dramatic for lower price, right? You know, versus $50 or $47, if the stock goes up $1, that's only like, you know, a 0.5%, 0.4% or whatever. Versus $3.07 for the option contract, if that thing goes up $1, you just made like 33%. Obviously, it's the same the other way. You are opening yourself up to greater reward, but you are also certainly making yourself exposed to greater risk by doing this.
Great.
Okay, cool. So this, look at that. It says the option drain. It's supposed to say the option chain. And option chain is an important, sorry about that, ladies and gentlemen. Option chain is an important part about getting involved, getting yourself into starting to learn about options contracts. So I have, unfortunately right now, Benzinga Pro doesn't have an option chain that we can view. However, I'm going to have you click over real quick, Mike, to something that I pulled up earlier, and this is what an option chain looks like. I'm just using TDA Ameritrade platform right here, and what we're seeing is I pulled up Tesla, and if you don't mind, Mike, can I zoom a little bit here? So I'm going to zoom in a little bit, and what we're looking at is these are all, maybe not all of them, but these are a large portion of the contracts that are available on Tesla right now. So there is, you know, what is this? This is probably like 15 contracts or so that are displayed right here. They're telling you, you know, how many days of expiration. What's happening when we look at this chain is you're seeing for the October 6th weekly contract, you're seeing a number of levels that you can bet on. You can bet on 360. You can bet that by tomorrow, the stock will be at 360. You can see how low value this contract is priced at. It's about 67 cents. So right now, traders aren't valuing that contract as probably pretty likely. However, you can definitely see that there are a lot of people making those bets out there. So if you want to start, you know, learning more about options, I would definitely recommend finding an option chain, your option chain on your brokerage account, and basically like clicking around and start trying to decide, start trying to do a little discerning in understanding what's different between, you know, like this weekly October contract and the November weekly contract. You'll get a lot of learning just kind of like clicking around. I can guarantee it.
Great.
Okay, sweet. So let's jump back over to Benzinga Pro real quick. And you did see some things as we were looking at the option chain. You've seen some things, you know, bigger numbers when we were looking at that first Tesla contract. If you don't mind, Mike, clicking back over that option chain real quick. Did you close it?
Nope.
Okay, cool. Yeah, open that up real quick. And then just click that top one. Yep, click right there. So look at this column right here. We highlight that volume that stands for, and then the next column stands for open interest. And so on Benzinga Pro, you can get automated, meaning it happens instantaneously when the market reacts. You can get automated alerts on when notable activity happens in the options market. So that's cool. You can minimize that now, please, Mike, and let's jump back over to Benzinga Pro.
Fred, I believe that was answering your question on getting the automated option alerts for unusual activity. And what that is our BZ signals here. You see the source that it's coming through. The signal source is an automated technology. And just to quickly show you, all I would do is come over here to sources. I would turn off Benzinga wire, and then I'm just getting Benzinga signals, and then I'm going to type in the word option up here. I could have just left it at up there in the first place, so moving a little slow here. Sorry.
That's all right.
And then, so this is all automated option activity that has somewhat of an unusual open interest to bid ratio.
This system that we've built is, you know, it's recognizing unusual things. It's recognizing notable activity. Let me give you a quick example. So we opened that Tesla option chain, and we saw how many contracts there were happening right now. So, like, Mike, minimize that October one for right now. So look at, so I said there was, you know, maybe 15 contracts, 15 expirations right here. Within each of these, there's at least, you know, like 10 strike prices. So this is, we're literally, right now, we're looking at hundreds of possible options. This is only one stock. This is only Tesla. How do you expect to monitor all of that stuff right now? Well, with Benzinga Pro, that's what we're doing here. This system it's set to parameters. We've set parameters. We've run this system a ton of times. We've specified our parameters. We've narrowed our parameters down. So you're only getting stuff that appears to be unusual. I don't want anybody to be making trades right off of what they see on this option activity until you're comfortable with it. But what you can be doing when you're just starting to learn this stuff is let it start your research. So turn on, your Benzinga signals like Mike showed us, filter by options, and you can look at all of these. And what you can start doing is, trying to understand why some of these are notable, and you just take a little bit of education away from it. So let me walk you through really quickly the parts that we didn't go over yet, really, on our own signal. So I told you about, the expiry. I told you about the strike price. It describes if it's a call or a put. This next little segment right here, we highlight sweep and the parentheses section right there. So we're not going to get too technical here, but basically what happens is there's a lot of exchanges, a lot of what is called routers giving orders out there in the marketplace. It's happening, a million times a second, and it's happening from a lot of different sources. What our system does is it is tracking a lot of different exchanges and routers, and it's grabbing the best orders from all of those. This isn't something normal. You can't really just like go on your brokerage account and get these what we call sweeps. The way that I think about sweep is it's sort of like our system is scanning all of these and sweeping them together, like with a broom sweeping. It's pooling them together, and that number in parentheses that Mike has highlighted, number 4 for Scientific Games, is the number of routers or exchanges or sources that we took these orders from. We took them from 4 different sources, basically. So at the bid or at the ask, that's where the price action is happening. I think you guys would be familiar with that. The next number that we're seeing, we highlight this, we'll stick to the SGMS example, highlight the 502 right there. So what that is showing is the volume that's happening at this contract currently. It's saying it's at a current price, which is about $3.07 versus open interest of about 64 contracts. Okay, so let's walk through this real quick. Oh, and I've got one more. It's the reference price. It's where the stock's trading right now. So you can look over and say, okay, stock's trading at about $47.65 versus this $50 call contract. So what is notable about this is the level of volume versus open interest. So this isn't exactly how it works, but this is how you can think about it to get a quick understanding. Let's consider volume to be the action in a contract for the last session, for the last trading session. So as of today, there had been, 502 contracts of the November $50 calls traded in Scientific Games just today. Before today, there was only 64 of those contracts traded in the entirety of this contract's existence. So it's a scale, it's a factor, it's showing you some kind of ratio. Let's use Bank of America here. Go up to that top one right there. Look at the scale in this one. So today we're seeing, we're looking at the April $25 puts showing volume of almost about 5,300. Before today, there was only 300 of those contracts that had traded. So I don't know why this is happening, but I don't necessarily need to know. All I need to know is that there is a ton of interest for whatever reason in this option contract. That's where I'm going to go start doing my own research and saying, is there something that I can, is there a research note that I can read and start doing my own understanding and try to understand why somebody else might be so interested in, shares of Bank of America going down about $1.20 in the next month or so. Oh, excuse me, April. That's a few months away. Sorry.
And then if you guys are anything like me, where you get a little bit confused with the calls and the puts, sometimes one thing that I've found is if their purchase price is either larger than the current reference price, then I like to look at it as bullish. But since this is a lower price than the current reference point, my thought process is he's expecting something to negatively affect this stock.
Right, exactly. You got it, Mike. That's a good way to describe it. Okay, real quick. So just want to mention that, like I said before, there are traders who they don't even do that exercising anymore. They just trade the contracts. They're just trading the options themselves. That's what I call, they're using a contract outright. They're just buying this instrument outright. However, a lot of traders use options contracts to hedge. So a hedge is basically, let's use an example. So let's say that we're looking at this Bank of America April $25 put contract. Maybe the interest in this issue is because there's a trader out there who is very long shares of Bank of America. This trader has a billion shares of Bank of America. This is their hugest position, and they are so exposed to Bank of America that if something goes wrong, they are just going to lose their butt. So what they do is they take a very small position in the other direction of their main trade, so that if something goes bad with that main trade, they don't just totally lose their butt, and they have a little bit of downside protection or upside protection.
Great. That could probably be a whole webinar in itself.
Absolutely. Yep.
Great. Anything you want to finish up with options? And then if anyone wants to drop in any questions about options before we move on to trading ideas.
All right. Give it a sec here, ladies and gentlemen, to get any questions in. Let's see. Nothing yet. Okay, cool. Let's keep it going, Mike. I don't have anything to add. I think we covered some good basics of options.
And then I know that we are getting a little long here, so thanks for bearing with us. We're going to try and rip through the trading ideas section here fairly quickly. If you guys have any ideas or thoughts on the trading ideas topic, please we can start getting the questions rolling.
Okay, so there are a lot of ways that somebody could find a new investment or trading idea. However, let's start with a couple basics here. I'm going to give you just a couple ideas, and maybe I'm sure we'll probably have another webinar where we're talking about some more ways that we can find new opportunities. So, Mike, click on the calendar for us, please. And we did get a question in here from Andrew. Thanks for the question, Andrew. If the call is less than the current reference price, I think he was looking for a little clarification, maybe, Mike, on what you were saying.
Yeah. So, like Brent said, most of the times you will see the puts being bearish and the calls being bullish. Is that correct?
Calls being bullish and the puts being bearish.
Yep. But I don't know if that is always the case. Is it always the case?
No, that's not always the case.
And so I think kind of with that, Andrew, same with my theory. You know, I believe it to be the case, but I don't believe it's always the case.
So it's just kind of like, I think Mike's trying to, have a little bit of a catch-all for sort of like some early understanding. When you get more advanced into this stuff, you won't have to depend on that little trick that Mike gave. So Andrew was saying, he gave us a specific ticker. I didn't see that one, Mike.
Yep, neither did I. Thank you for that.
Okay, so he's looking at the Mankind option alert. MNKD is the ticker. So we're looking at the, if you are referring to this option alert from today at 12:28, Andrew, let us know. It looks like he's looking at the November 450 calls, showing volume contract of about 1,800 versus open interest of about 131. And okay, so what's happening here, Andrew, is this call is showing activity at the bid instead of the ask. So what that means is basically the exposure is to the downside right now. So Andrew found a case where it was a call, but the strike price was below the reference point. This activity that you're seeing here, Andrew, because it is happening at the bid, it's actually a bearish reference. So if you see a call contract happening at the ask, that's generally bullish. If you see a call contract happening at the bid, that's generally bearish. Flip that around, if you see a put activity happening at the ask, that's generally a bearish thing. If you see a put activity happening at the bid, that's generally a bullish thing. I hope that helps you, Andrew. Let's keep chugging along back here to trade ideas.
Excellent.
Thanks a lot for the question.
Yeah,
Andrew.
great question, Andrew.
Okay, so one way that you can think about getting some new stuff you want to trade in or invest in is to know what's coming up ahead of you. And one way you can do that is you can use a calendar. There's, a ton of calendar services out there. The one that we developed on Benzinga Pro does a really good job at tracking upcoming earnings reports, upcoming notable economic data points. We looked at dividends earlier, analyst ratings. This is all stuff that except for analyst ratings, this is all stuff that you can get ahead of. If you do your homework, if you use a tool like a calendar and look to see what's in front of us, you at least won't be caught off guard when something crazy happens. And if you know that there is a notable event that is going to create some volatility in a stock, like an earnings report, or if you're looking at a biopharma or a biotech company, some kind of FDA date coming up, you can basically position yourself ahead of that strategy.
Awesome.
Cool. A couple more quick ways you can get a couple new ideas is look around the sector. So I'm describing here sympathy plays, peer plays, and sector moves. I got a couple quick examples I want to show off really quick. So Mike, I want you to open the newsfeed. And do you got Benzinga wire on? Cool. So type in the ticker DAL, Delta. So look at what happened here the other day in Delta. So highlight this headline right here, Mike. It was a headline from Tuesday, October 3rd. I'm just going to read it out loud. So Delta gave a little bit of guidance earlier. I think it was the day before, or they gave some, what was it? They gave some traffic figures. And the results were strong. The results weren't as bad as people were expecting. People were expecting Delta to have some like potential revision to their numbers because of the hurricanes that were happening. They came out with their numbers. They weren't as bad as some people thought they were going to be. And as Delta shares moved higher, the entire sector moved higher. Not only did Delta move higher, 6%, Spirit Air, United Air, American Air, Southwest, SkyWest, Alaska, they all moved up because there was this expectation that the airliners could potentially be hurt by this hurricane season. At least for Delta, it doesn't seem to be the case. In response, stocks went higher. One more really cool one I want to show off as far as like a sympathy peer potential sector move. Check this one out. So this one, I think this was just yesterday. This is ticker CBAK. It's China Back Energy Technology. So Ford and GM over the last couple of days have been issuing some news related to electric vehicle, battery stuff, kind of like autonomous stuff, that kind of thing. And on the heels of some of this news, there was a couple plays yesterday that were moving in sympathy. They were moving because the sentiment on GM and Ford was being exposed. Investors and traders know that Ford and GM are going to be making moves into electric vehicles and batteries and etc. So a couple of these plays started moving because of this company, KNDI. They are like a electric vehicle company. I don't know exactly what they do, but they're in the electric vehicle sector. Stocks started moving higher, probably because the traders and investors are going, okay, well, if Ford and GM is going to be getting more exposure into this space, is there another way we can play electric vehicles besides buying GM or Ford or Tesla? Cool. One more. I'm going to skip over the ETF one right now. Sorry, ladies and gentlemen, if anyone was excited about hearing some details on that one. Go to, rumors, Mike. Thank you. So our rumor feed is a great source of volatility, is a great source of getting some new ideas. One that I wanted to show off right now. So keep that on, Mike. Close that. Go to, I want you to highlight Kroger. So look at the third headline down. Just highlight. Oh yeah, that's fine if you want to do that too. So look at what happened here. Click on the ticker, Mike. I want you to open a chart.
Great.
And let's see what happened in Kroger shares earlier. So look at that green shortly after the open. This headline that I'm looking at was from about 10:07. Look at the stock moving up into that 10 o'clock hour. It hit a session high by about 10:10 or so. What happened? What we uncovered, what we determined to be driving shares of Kroger over, the first part of the day was traders passing around this report from a German paper, not very reputable source, or at least it didn't seem. In that article, that reporter was referencing a Twitter account that had suggested something about a German company looking at Kroger as a potential takeover target. Something that seems sort of crazy, but basically what happened is we said, so we see the stock moving, some traders telling us why they think it's moving. We look around at the evidence and we're like, this is old stuff. This stuff is, from a couple days ago. It probably shouldn't be impacting the stock. So what we try to do is we try to give you a heads up. We try to, show you that this is old information. It looks like the market's moving on it, but it probably shouldn't be. And look at what happened to the stock. It actually sold off from the highs. So a really, quick example of how you can leverage some of these rumors. Whether the rumors are true or not, I want people out there to look at them as potential opportunities. If you find that, what happens with a lot of these rumors that make it to this feed, if they sell off after, hitting a high, well, view that as an opportunity. Remember that the next time you hear about one of these rumors and, consider, okay, does this look like a time when maybe I can start shorting a stock or going long a stock?
Awesome.
Cool.
Any of you listeners out there have any last minute questions, feel free to drop them in.
I got one more quick thing, Mike. Hit the categories button real quick. And we actually have a category designed specifically for what we call trading ideas. So click off rumors, scroll down just a little bit more. It's the last one. Click that one. Let's filter by the ones that a reporter on the Benzinga team has deemed as potentially being a trading idea. So what you did when you turned this category on is you also opened up to some Benzinga.com articles. So you're going to be seeing some Benzinga Pro headlines in here. You're also going to be seeing some Benzinga.com articles. How you can signify if it's a Benzinga.com article or a Benzinga Pro headline is you have this kind of like gray text after that's indicating that there's some more body in that headline.
Excellent.
Cool.
Great.
Woo! I'm like sweating.
Yeah.
That was a lot of information.
Brent, you definitely dropped some knowledge on us today.
Sweet. No problem.
Really appreciate you joining us and taking some time out.
No problem.
Fun. All of you guys that are listening, thank you for joining us. There will be, Terry, this is for you. There will be a recording that will be sent out right after this. It does take a little bit from our marketing team. They tend to move slow here and there. I'm just kidding. But yeah, as soon as it is uploaded and quickly edited, Mr. Andrew Weiss will have that sent out to you guys so you guys can take a look at it. There's also a website here that I will drop into the chat.
Where are you? I have no idea where you're going with this.
That you guys, all of you listeners, can take advantage of. It has all of our previously recorded webinars, and also over in the right corner. I'm glad the internet decided to go slow now.
Nice.
Here in the right corner, it will show you ways you can sign up for the upcoming webinars. So, last week's webinar is right here, week before right here, et cetera, and then signing up for the next one. Also, what I would highly recommend anyone that's listening to sign up for these newsletters. Analyst Ratings, Market in 5 will give you a lot of amazing information. If you're interested in financial technology and kind of what's going on in that space, definitely sign up for this one as well. But these two will be very educational towards the markets, and the FinTech focus is a little more of a entertaining educational piece.
The Market in 5 minutes, so it's kind of what it sounds like. We want to get you prepared for the market in 5 minutes. It is a morning newsletter. It goes out about 7 a.m. Eastern time each morning. It has top highlights from Benzinga, top highlights from other publications. It has the top news item that has links to a lot of content, Benzinga content, other publications content. We're trying to prepare you for your day of trading in just 5 minutes. And, maybe I can get a little plug in here too, Mike. If everyone out there is looking for some more educational resources, and here, actually, Mike's pulling up the Market in 5 minutes right now. So you got top stories from Benzinga, top stories from the WSJ, you got top stories from Reuters, from Bloomberg, you have your upcoming earnings reports for the day, you have economic data for the day, you have some notable analyst rating changes, you have some rumor talk, you have a quick little option recap. It really has a ton of good information that will prepare you each day. And the other thing that I was going to pitch really quick,
I know it,
and I'm doing it because I think that this audience is receptive to it. If you guys are here on the webinar and you're looking for education, this is an excellent source for education. This is Benzinga's Pre-Market Prep. It is a morning radio show. It runs from 8 a.m. to 9 a.m. Eastern Time, Monday through Friday. There are a couple of very seasoned, excellent traders who are the hosts. And what they do, Joel Elconin and Dennis Stick, what they do is they go over the top news items for a day, and they're technicians, they're technical guys. They love charts, they love, support and resistance, that kind of stuff. They offer you the top news items of the day, they pull up the charts, and they let you know the important levels that you should be watching out for while you're accounting for that news of the day.
Excellent. And then you guys can also sign up. It's completely free for this chat room. There's a handful of traders that are actively posting in there and keeping
their own trades,
absolutely.
The stuff that they just traded. It's really cool.
Yep, absolutely. So go ahead and take a look at that if you guys are looking for a little more information. Completely free, and like I said, even you guys out there can drop in questions in the chat in the morning, and they will try and position some of their conversations that day about what is going on. Anything else that you'd like to add here, Brent?
No, sir. That's good.
Excellent. So I really appreciate all of you guys joining us today. Wishing you guys the best trades for the rest of the day and the rest of the week, and hope to see you guys next week.